Welcome to our Lunch and Learn webinar series. Today's topic, Tax Updated, a review of tax changes impacting small businesses, including a detailed review of the tax on split income proposals, is brought to you today with the support of our sponsor, the University of Fredericton. My name is Tanya Seneschal, and I am the event manager at the Fredericton Chamber of Commerce. Our presenter today is Katie Rogers of Deloitte. Katie is a senior tax manager in the Deloitte New Brunswick practice. She has over 13 years of experience advising private companies and their shareholders in the areas of tax planning, tax compliance, and tax controversy. Katie works with owner-managed businesses as well as large multinational entities and their high net worth owners. Katie ensures her clients have a local contact and support while coordinating and leveraging Deloitte's tax subject matter experts from across the globe. Katie has developed and delivered a number of tax learning courses and has been a tutorial leader for CPA Canada's in-depth tax program. She has also presented at PD sessions for CPA New Brunswick. Ladies and gentlemen, please welcome Katie.
Thank you, Tanya, and welcome everyone to today's session. I would like to thank the Fredericton Chamber of Commerce for inviting me to speak to you today. When they reached out, they asked me if I could do a presentation on tax updates. And as I'm sure you're all aware, there certainly have been a lot of tax updates lately from the U.S. tax reform and the private company proposals in Canada. There's lots of things we could talk about. Today I am going to focus on the proposed tax changes for private corporations. I will give you a brief overview of other measures that were announced in the most recent federal budget on February 27th, and just a couple other interesting items to note. The proposed tax changes for private corporations were first announced in July of 2017. When they were announced, many were saying that these changes were the most significant change in Canadian tax policy since 1972. There were three main areas of importance that the proposals focused on: income sprinkling, passive investments in a private corporation, and capital gains. There was a lot of pushback around the proposals when they were first announced. There were a number of concerns raised about the complexity of the rules and the costs that would be incurred in order to understand the rules and, of course, to comply with them. For example, I threw a couple of numbers up on the screen. When the proposals were announced, there were three areas that were covered, as I mentioned. One of the areas, passive investment income, no legislation was introduced with those changes. So for the two other areas alone, there were 27 pages of draft legislation, and 25 and a half of them related to the concept of income sprinkling. So there were a lot of details to be absorbed, and there were a lot of complexities. There also were a number of unintended consequences included in those proposals. There's also concerns relating to the uncertainty that it would create for taxpayers. For example, there are terms that were used in the proposals that weren't defined within the Act. One of those terms is reasonable, and that term was used more than 20 times in the proposal. And another term that's not defined but is often used is the term significant. So there was a lot of pushback that resulted. So let's look at how these proposals developed. There's a timeline on the screen now, and it starts way back in 2015 when the Liberals first announced their platform during that election. At that time, there was reference to the taxation of private companies and high net worth individuals. And so that was the first notification that they were going to focus on this area. And then, as I said, in July of 2017, they actually released their consultation document. And there was a 75-day consultation period where the tax community and interested folks across Canada could submit their comments. The deadline was October 2nd, and exactly 2 weeks after that deadline, the Minister of Finance had a series of announcements relating to these proposals, which was really interesting. And then in December, there was another announcement, and this one was specific to the tax on split income, which we'll talk about in more detail. And then finally, most recently, in February, was our federal budget for 2018-2019. So you can see how things progressed. They were originally announced in July. We had changes announced in October, additional changes announced in December, And in February, when the budget was released, there were even more changes. So I'll take you through each of the 3 areas of importance. We'll talk about what the initial proposals were and how they've changed since they were initially announced. Before we get into the 3 areas of importance, one of the other announcements that was made in October was a change in the small business tax rate. So this wasn't something that was originally included in the proposals in July. At that point, it was expected that the small business tax rate would stay the same at 10.5%. However, in October, it was announced that the rate would actually be decreased over the next 2 years, going to 10% on July 1st of 2018, and then down to 9% on January 1st of 2019. This was confirmed in the budget that was announced in February of 2018. So then that brings us to the first area of importance, which was included in those July proposals, and that is income sprinkling. And as part of the income sprinkling proposals, there were also changes proposed with respect to the lifetime capital gains exemption. For income sprinkling, or often called income splitting, this refers to shifting income from a high-income earner to a lower-income earner to reduce the overall taxes that are paid by a family by taking advantage of the lower tax brackets and lower tax rates paid by the individual that's earning a lower income. The proposals in July included an extension of a tax that already existed, the tax on split income, which applied to minors, those who were under the age of 18. The initial proposal said that the rules would be extended so that any individual that was earning income from a related business would pay tax at the highest rate unless that income was determined to be reasonable. During the week of October, when all the various announcements came out, there was no mention of tax on split income changes. However, in December, new proposals were introduced, or changes to the initial ones, but they were some pretty drastic changes, and these were intended to be simplified proposals. There was some relief announced for payments made to spouses at the age of 65, and this was based on a lot of feedback that they would have received because income splitting is available for pension income if you're not a business owner. So they wanted to have the same relief for business owners. So that was included in the changes in December. They also added new definitions for excluded amounts. So basically there were new ways that you could get out of the new rules so that TOSI wouldn't apply. And then they also said that owners would have until the end of 2018 to adjust their shareholdings so that they could fall into the new definition. We'll go through each of those in more detail. The TOSI rules were not further amended in the budget. The lifetime capital gains exemption changes that were initially announced in July introduced a lot of restrictions on who could actually access that capital gains exemption. And the intention there was to limit the ability of taxpayers to multiply the use of the capital gains exemption. There were a lot of concerns raised about the ability to transfer businesses to family members, and during October, it was announced that those proposals would be abandoned, which was a welcome change by many. We're going to do a deeper dive now on the tax on split income and the history of it. It's not a new concept, and in fact, the rules that exist today were first introduced as part of the 1999 budget. The rules were introduced at that time to prevent adults from shifting income to their minor children. And so the rules basically say that if a child under the age of 18 receives income from a private corporation or through a trust or partnership from a related business, then that income will be taxed at the higher rate. In doing so, there's no incentive to shift that income to the minor if they're going to pay the tax at the highest rate. The rule applies by asking yourself a series of questions. The rules apply, first of all, to a specified individual. And under the current rules, a specified individual is someone who has not yet reached the age of 18. They're below 18. And their parent was a resident of Canada throughout the year. The next test is, what is the type of income that the individual is receiving? Is it private company dividends, or is it business income from a related party? If so, then TOSI would apply, and TOSI is what we call tax on split income, or sometimes kiddie tax. Before you jump to the conclusion that TOSI applies, you would ask yourself whether or not the income meets the definition of an excluded amount. And under the current rules, the definition of excluded amount is very simple and very basic. It basically is any income that comes from a property that was acquired from a deceased parent, or if the individual receiving the income is attending a post-secondary institution or is eligible for the disability tax credit, they are able to inherit property from any person, and the income from that property would also be considered excluded. So basically, under the current rules, if you're under the age of 18, your parents are resident of Canada, you're receiving income from a private company or related business, and that property on which you're earning the income was not inherited, then TOSI applies and you would be subject to tax at the highest rate. Under the new rules, the decision tree looks much the same. There's the specified individual concept, the split income concept, and then you get into the excluded amounts. And for purposes of this presentation, I've split them into two components. The first being what I consider to be fairly unique situations, very fact-specific, and then the second are more common excluded amounts. And these are the scenarios that most people will try to fall into to get out of the TOSI rules, and that some planning may be done to be able to fall into those excluded amounts. And I've heard people often refer to these excluded amounts as off-ramps. So if you're going through the series and asking yourself the questions, am I a specified individual? If yes, you move on. Am I receiving split income? If yes, you get to the excluded amount. Is the amount that I receive excluded? And so this is where you want one of the excluded amount definitions to apply, and then you can take the off-ramp so that the TOSI doesn't apply to you. So we'll look at each one of these steps individually. The first being whether or not the individual is a specified individual. As I mentioned, under the current rules, a specified individual is someone that is under the age of 18. However, under the new rules, it has been extended to include those also over the age of 18. So basically now, a specified individual is anybody who's a resident of Canada. So the scope has been broadened. So now we move on to the next question. Is the income that is being received split income? Under the current rules, split income is private company dividends. It also includes partnership income from a related business, and that includes rental property income, where a related person is involved. It also involves trust income that is allocated if that trust income is coming from private company dividends, shareholder benefits, and partnership income or income from a related business. So the new rules with respect to split income add two new types of income. The first being income from loans. So if there's any interest income earned from loans, that would now be considered split income. And secondly, income or gains from the disposition of certain properties. So the key here is if you have property, let's say you have shares in a private company, and if you were to receive dividends on those shares, that dividend income would be considered split income and subject to TOSI. Then when you eventually sell those shares, then the gain on the disposition of those shares would also be considered split income. There are some exceptions, and we'll get into those as we look at the excluded amounts. So if you're a specified individual and the amount you're receiving is considered split income, now you look to the definitions of excluded amount to try to see if there's an opportunity to fall into one of these definitions. So let's start with the unique ones, the unique excluded amounts. The first one is basically the same rule that previously existed for an excluded amount, and that is with respect to inheritances. So if you are under the age of 24 and you have received income as a result of a death of a parent, or if you're a post-secondary student or eligible for the disability tax credit, you've inherited property from any person, the income from that property would not be subject to TOSI. It would be considered an excluded amount. The second is income that is earned, or taxable capital gains, on property that is acquired as a result of a divorce or separation. Third, and these are some of the exclusions I mentioned with respect to the disposition of property. If there is a taxable capital gain that is arising because of a deemed disposition on death and there's no actual disposition, then that is an excluded amount. And then finally, if the taxable capital gain is related to the disposition of qualified small business corporation shares or qualified fishing and farming property. If none of those situations apply and you haven't yet met the definition of an excluded amount, we can look to the more common, what I'm calling common components of the excluded amount definition to see if there is a potential off-ramp we can take so that the new rules wouldn't apply. Under the common situations, the rules are split up into 3 different age categories. The first age category applies for individuals who have reached the age of 17 before the year. If they have reached the age of 17, then you ask yourself whether or not that income is from a related business. If the income is not from a related business, then TOSI will not apply. A related business is one where a related person is actively engaged in the business, or a related person is a partner in that business, or they have an ownership interest. And the ownership interest has to be 10% of the value of the company. For example, if I'm a specified individual, I'm over the age of 18, and I'm earning income from dividends from a business, and the person who owns the business is related to me, then that income is coming from a related business and I don't meet the definition of an excluded amount. The second option for those who have reached the age of 17 is whether or not the income was derived from an excluded business. An excluded business is a business where the specified individual is actively engaged on a regular, substantial, and continuous basis. Under the new proposals that were announced in December, a bright line test was introduced to help substantiate what is meant by regular, substantial, and continuous basis. And the bright line test says that where an individual is working 20 hours a week in the business during the period of the year that the business operates, then they would be considered to be actively engaged, and therefore they would meet the definition of an excluded business. To be actively engaged in the business and to have the definition apply, you have to be either actively engaged in the business in the current taxation year or in any 5 prior years. So basically, if you're actively engaged in the business for any 5 prior years, dividends can be paid to that individual in the future. The 20-hour test is a bright line test, but there's also a factual test, because there may be some businesses where it's not required that the individual be working 20 hours a week. Maybe the individual has specialized knowledge or skills and they add greatly to the business, but it doesn't require them to be actively involved 20 hours a week. They can still meet that definition of being actively engaged and therefore would fall into the excluded amount definition. Some of the key things to keep in mind if you're intending to rely on this definition to get out of the TOSI rules, it's important to be able to support the hours that are being worked. So tracking those hours through timesheets or other means would be important. And also, if it doesn't already exist, having job description to explain what it is that that individual is doing during the 20 hours a week. The second age category is for those between the age of 17 and 24. There are 2 additional excluded amounts that may apply. The first being a safe harbor capital return. So the safe harbor capital return is basically taking the fair market value of any property contributed by the specified individual and multiplying it by the prescribed interest rate. And right now the prescribed interest rate is very low, it's 1%. So the return that an individual between the age of 17 and 24 can make is very low. The second excluded amount for individuals in this age category is where the individual earns a reasonable return on contributions of arm's length capital. So if an individual is able to access and has arm's length capital, they contribute that to the company, they're able to earn a reasonable return on it. So let's first focus on what is arm's length capital. Arm's length capital cannot come from a related business. Therefore, receiving a salary from the business and then reinvesting it would not be considered arm's length capital. It cannot be borrowed, and it cannot be loaned or transferred from any related person. So it truly has to be obtained from another arm's length basis. So that may be difficult for someone between the ages of 17 and 24 to find capital. It would come from perhaps working in another arm's length business, winning the lottery, if the individual had public company securities that it could sell, but it does have to come from an arm's length source. If the individual does have access to that type of capital and does contribute it to the company, they are then able to earn a reasonable return. And when determining what is reasonable, you look at relative contributions from others who have contributed to the business. And you look at the work that they contribute, the capital they contribute, and other amounts that they receive. So finally, the third age category is for those who have reached the age of 24. So once an individual has attained the age of 24, there are two more tests. So you can see as the individual ages, there's more and more options to fall into the definition of excluded amounts so that the TOSI rules don't apply. And so the first for those that have reached the age of 24 is if the income or the taxable capital gains come from the disposition of excluded shares. So excluded shares is, again, another new definition, and it actually has a number of tests to meet that definition. So the first is excluded shares will not apply if it is a professional corporation. So it was very clear that the rules wanted to prevent any income splitting from happening with respect to professional corporations. The second test is that the income that's earned from the business cannot be more than 10% of the income can come from services. So basically it can't be a services business, or only a small component of the income can come from services. If those two tests are met, then you move on to the next test, which is that the shareholder, to be considered excluded shares, they have to be shares where the shareholder owns 10% of the votes and value of the company, and the shareholder has to hold those shares directly. They cannot be held through a trust or a holding company. And then finally, 90% or more of the income from the business must come from non-related sources. So the income can't be coming primarily from related businesses. So there are a series of tests to be met. But basically, if you have a situation where an individual owns 10% or more of the votes and value of the company, it's not a PC, it's not a service corporation, and the income being earned is not from a related business, or less than 10% of the income being earned is from a related business, then the definition of excluded shares is met, and dividends can be paid and other income can be earned that won't be subject to TOSI. And finally, if the individual is over 24 but doesn't meet the excluded share test, maybe they don't own 10% of the shares, but they are working in the business or they've contributed capital to the business, they're able to earn a reasonable return. And again, the factors that are considered for a reasonable return is the labor contributed, the capital or assets contributed, any risk that is assumed, if guarantees are signed or provided, for example. And then finally, it also looks at what other amounts are paid. So for example, if an individual is working in a business and they are providing services that would generally be worth $100,000 if paid to an arm's length person, and they receive a salary of $50,000 for those services, then a dividend of up to another $50,000 could be paid. Anything in excess of that would be considered unreasonable. So a lot of definitions to consider. I've included them all on subsequent slides here, but I'll click through these because we have gone through all of them in detail. And so that brings us back to the decision tree, and you go through the series of questions. Are you a specified individual? If yes, is the income you're earning split income? If yes, do any of the excluded amounts that are unique apply to me? If no, do any of the excluded amounts that are more common apply? You look at your age and then look at the test that could apply to you. And if the excluded definitions don't apply, then unfortunately you will be subject to the tax on split income, and you will be paying tax at the highest marginal rate on that income. A couple other things to note with respect to these rules. One of them I mentioned was announced as part of the December changes with some relief for those over the age of 65 to allow for income splitting into retirement. So the rule that applies here is basically an individual can receive an amount and TOSI won't apply if that individual's spouse has attained the age of 65, and if the spouse were the one to receive that income, he or she would not be subject to TOSI. So if that individual is actively engaged in the business or contributed capital, if they were to receive it in their own hands, TOSI wouldn't apply. It can now be paid to their spouse once they each reach the age of 65, and TOSI won't apply. There were also rules announced with respect to how the inheritance exclusion works for people over the age of 17. And so if you're over the age of 17, you inherit property. When going through the series of TOSI rules and the excluded amounts, you would look to what the deceased person contributed rather than the individual who has inherited the property. So when determining what is a reasonable return, you would look to, well, what did the deceased person contribute to the business, and what would have been a reasonable return for him or her to earn? So what planning is available with these new rules? A lot of people are really focusing on the definitions of excluded amounts and saying, how can I plan into this if it doesn't already apply to my situation? So when you're looking at the excluded business definition, which was the bright line test of 20 hours or being actively engaged in the business, as I mentioned, that rule applies if you are actively engaged in the current year or for any 5 prior years. So in situations where you're paying amounts for 5 years, or you're actively engaged for 5 years, then you can pay future dividends without having to worry about looking at the rules every year and tracking the hours after the 5 years have passed. The second one is planning into the excluded share definition. So this would, if there is service income within the business, you may want to manage that income so that it's less than 90% in that company. It's also important to ensure that the specified individual does own 10% of the votes in value directly. And there was some relief granted in the new proposals in that an individual has to the end of December 31st, 2018 to reorganize their shareholdings if necessary. So that gives you the opportunity to ensure that the right people hold 10% of the votes in value directly if it makes sense for you. There are also opportunities with prescribed rate loans, either to a family trust or to a spouse. And then there are other ways of having an individual get income into their own hands. So one strategy is melting down a spousal RRSP, and then the spouse is earning that income in their own hands. It can be reinvested, and then it'll be taxed in their own hands at a lower rate. And then you may also want to consider switching from dividends to salary, and then using the salary to contribute to an RRSP and taking advantage of that deduction. So that brings us to the end of the tax on split income proposals. Next up, I will talk about the passive investment income proposals. So passive investment income, when this proposal was first introduced, the main purpose behind it was that the government wanted to reduce or eliminate the perceived advantage that's available to corporations when they earn income within their corporation and they're paying tax at the small business rate, That means they have more after-tax profits to invest when compared to an individual who earns the income personally and pays tax at a much higher rate. They have less income that's otherwise available to invest. And so the rules, although there was no draft legislation announced, there were proposals that were presented as to ways that they could accomplish reducing the after-tax income available within the corporation to even out the amounts that were available to invest within a corporation versus someone personally. During the week of announcements in October, there were a couple key things that were announced that were seen to be welcome changes. It was announced that any rules, once decided with respect to the passive investment income, wouldn't impact any assets that had been accumulated prior to the new rules coming into effect. So a lot of people would refer to this as a grandfathering provision. And then they also announced that a corporation would be able to earn up to $50,000 of investment income a year before the new rules would apply. Moving forward to February, when the budget was announced, two new rules with respect to passive investment income were introduced. One of them relates to looking at the associated group and their ability to claim the small business deduction, and then reducing that small business deduction based on the passive investment income earned within the group. And then the second rule was with respect to the refundable dividend tax on hand. So there are situations where companies could pay eligible dividends out to their shareholders, and eligible dividends have a lower tax rate than non-eligible dividends. And so the individual would pay tax at a lower rate on the dividends, and the company would receive their dividend refund at a rate that was actually higher than the tax that was being paid on the eligible dividends. And so the new rules will actually take that RDTOH balance, split it into two pools, eligible and ineligible, and you'll have to track the income earned and the dividends paid or received, and so that you don't have a mismatch of eligible dividends being paid and a dividend refund being paid out of the non-eligible pool. So this table was taken from the budget documents, and it shows the impact of that first rule that was announced in the budget, where you look at the passive investment income that's earned within an associated group. The business limit for the small business rate is $500,000. And so you can see how that interplays with the $50,000 de minimis threshold that was announced in October. So to the extent the associated group earns passive investment income up to $50,000, there is no impact on their business limit. It stays at $500,000. As soon as that passive investment income exceeds the $50,000 threshold, you can see that the business limit starts to decline. And then once the passive investment income reaches 150, the group is not able to claim or pay tax at the small business rate on any of its income. The business limit has effectively been reduced to zero. The third area of focus in the proposals was capital gains. And the focus of the government in this area was to prevent to prevent shareholders from extracting funds out of the corporations using preferential tax attributes. For example, adjusted cost base or CDA. By using those attributes, the shareholders could pull the funds out of the corporation and pay less tax than they would if those funds were taken out as dividends or salary. And the proposals had a very retrospective nature to go back in time to see earlier dispositions of the shares between non-arm's length parties. And it created a lot of unintended consequences, we believe, with respect to transferring businesses to the next generation. During the week of October, when the announcements were made, the government did announce that they weren't going to continue with these proposals at this time. They did say that they're going to examine the area for future changes and that they were going to spend time over the next year looking at that. And so some people may speculate, are they going to sort of bring those same proposals back to the table, or will they change them? Will there be a change to the capital gains inclusion rate? It's not certain, obviously, but they are still looking at capital gains, and we do expect to see some new rules introduced with respect to them over the next year. So what could be next? As I mentioned, we're waiting to hear the outcome of the one-year consultation for the capital gains. And then all of the rules that have been announced and the draft legislation that has been put forward has not yet been enacted. So it's still just proposed legislation. So we would expect to see either further changes or actual enactment of the changes as they have been put forward. All right, so I'm just going to pause there. There is the ability to ask questions using the chat function, so I'll just pause, and if anyone has any questions, feel free to type them in. I know it may take a bit to type it, but I will go into the next section, which is a few highlights from the federal budget, but please don't hesitate to ask questions if you do have any. So we talked about a number of the private private business measures relating to tax, but there are a few other business tax measures to be aware of. They're pretty specific, so I'm not going to spend a lot of time on them, but just be aware that there were changes to losses used by members of a partnership where there are tiered partnership structures. They did extend the eligibility for accelerated capital cost allowance to certain properties. This was extended to 2025. There were some changes to dividend rental arrangement and securities lending arrangement rules. There were also changes with respect to situations where a corporation repurchases its shares. There was a discontinuance of the CRA's long-standing administrative position with respect to Health and Welfare Trust, and that is after the end of 2020. And then new rules relating to cross-border surplus stripping when there's use of trusts or partnerships. And if you do have foreign affiliates in your structure, please note that there are additional and shorter deadlines relating to those entities. On the personal tax side, there were some new requirements introduced with respect to trusts. Now, these are not effective until 2021, but they are announced now. So there will be a requirement going forward to report the identity of all trustees. And certain trusts that may not have a filing requirement now because they don't have income will have a requirement going forward. Some of the other rules that are announced were with respect to extension for mineral exploration tax credits. There were some changes to the naming of the working income tax benefit. That's now known as the Canada Workers Benefit. Some of the items that are eligible for the medical tax credit, they were going to expire this year, but they've actually been extended. And there's also a few other changes there, but nothing really overly significant on the personal tax side this year. And then as far as other measures, the federal government did announce what their excise duty framework will look like for cannabis products. And there were also some adjustments in rates for tobacco excise duty and cigarettes. So overall, there wasn't a whole lot of tax changes for Canadian corporations other than those that we've already discussed. So next up, I just wanted to give you an update on the voluntary disclosure program. For those who may not be familiar with the program, it was a program that was introduced to incent taxpayers to come forward when there may have been an error in a tax return and or a return was never filed. And what the program did was it would offer relief from penalties and interest. So the CRA did announce in June of 2017 that they were changing the program and that the changes would be effective January 1st of 2018. And there were some pretty big changes. So first of all, one of the changes was that they would no longer allow for a no-name submission under the voluntary disclosure program. And they introduced two tracks for this information disclosure. So there was the general program, which was their normal program for non-compliance, and then there was the limited program. So under this new limited program, the only relief that is afforded will be relief from criminal prosecution and gross negligence penalties, which means if you make the voluntary disclosure, not only will you have to pay any taxes that may be owing, but you will also have to pay the interest and penalties. And the only thing you'll get relief from will be criminal prosecution or gross negligence. The changes also involve the limitation to your ability to object. So if you were to submit under the voluntary disclosure program, you're limiting your ability to object on CRA's assessment of what you submit. There's also now an upfront payment that would be required of any anticipated tax that is owing, and you also have to disclose any advisor who assisted you with the application. Further, there were new rules introduced that says who is not eligible for the traditional VDP relief. And so this is basically focusing on large corporations, those that have excess revenue, revenue in excess of $250 million, or if they have matters pertaining to transfer pricing adjustments or advanced pricing arrangement applications. I've seen voluntary disclosure used a lot in the past where a taxpayer has an information return that needs to be filed. There's actually no tax owing, but there are penalties assessed if the information return is not filed on time. And so I've often seen where a taxpayer will do all of the information returns for a number of years and submit them, and then they would have relief from those penalties. But now, tax returns where there is no tax owing or refunds requested will not be eligible under the program. And they also specifically excluded situations that involve large dollar amounts or sophisticated taxpayers, or situations where there are multiple years of non-compliance. So it's really restricting where the VDP program could be used. And just some updates on timing. Originally, the changes were supposed to be effective January 1st, but the CRA did release their final policy in just December of 2017 and said that the new rules will apply on or after March 1st, 2018. So they are in effect now. All right, and the final item I wanted to raise was with respect to Quebec and any GAR-based assessments. So Quebec, it doesn't apply just to Quebec corporations. These new rules could also apply to a New Brunswick corporation, for example, that has a permanent establishment in Quebec. So that's why I wanted to raise it today. So these measures that were announced can have a significant impact not only for the corporation itself, but also for any of their advisors. So GAR is the General Anti-Avoidance Rule. And when the Quebec tax authorities make an assessment under GAR, there were significant penalties imposed. And they've actually raised those penalties from 25% of the amount of the tax benefit denied to 50%. And where an advisor was involved with that tax planning that led to that GAR reassessment, the advisor will actually have to pay penalties equal to 100% of the fees that they would have had in relation to that tax planning engagement. Not only are there significant penalties involved, but the second measure that was announced is that the taxpayer and the promoter or the advisor that was involved in the transaction will not be able to enter into any public contracts with the Quebec government. So if you're in a business that actually relies on doing contract work for the government or others providing other services, this could be significant to your overall business. So I just wanted to make sure that everybody was aware of those changes. So that brings me to the end of my presentation. If anybody has any questions, you can go ahead and type them out in the chat function. I'm just having a look through now. I see a couple things have come in. Has there been any mention of examining the benefits of shared insurance plans? I am not sure about that, but if you want to connect offline, I'm happy to do that. My contact information is on the screen now. Please feel free to send me an email and we can delve into that a bit further. Thank you all very much for attending. I'm going to pass the mic now back to Tanya. Have a great afternoon.
Thank you, Katie. And as an appreciation for your time and your expertise today, the Chamber will be making a donation in your name to our scholarship fund. I would once again like to thank and acknowledge the University of Fredericton for sponsoring our Lunch and Learn webinar series. If you would like to watch this webinar again, or if you'd like to pass it along to any of your coworkers, anyone who may be interested, it will be posted on the Chamber's website and YouTube channel within the next week or so. Thank you, and have a great day, everyone.